Hello.
Hello.
So we're still waiting. We're still waiting for John to join.
That's me.
Oh, hey, John. Okay, cool. Okay, good. So I think, yeah, people are joining. We have 15 guests already.
Okay.
So I'm enabling Q&A session. If anyone wants to send a question online as we speak, please do it on the Q&A part. So on this AMA session, and AMA is Ask Me Anything session, we have some of the experienced people that are working with technology. Hello, Andres. That are working with technology and innovation in various industries. And in our first batch, we had people like Vincent Gerf from Google, Vincent Cerf from Google, and many other people. Today we have John Bradford. John is a co-founder of F6S, of Tech.eu. He founded a startup accelerator called Springboard, which later on was acquired by Techstars, if I'm not mistaken, if that's a correct word. And then he did quite a few batches of Techstars London. John is also an advisor of Startup Scale-Up Project. And today John will share his experience with us. One of the accelerator programs that John did was with IoT, right, John?
That is correct.
Yeah. Okay. Great. So John, first of all, as an introduction, so I briefly touched some of the titles that you had. What are you doing now? Because as far as we know, you left Techstars, or you're not with Techstars anymore.
Yeah. So I left Techstars just over 6 months ago, and I have been working on a new project, which is essentially a new venture fund targeting fintech, which I would hope is going to launch in the next couple of months.
Great, awesome. So John, can you please share with us some of your experience with the IoT program that you did? It was still Springboard program, right? Yeah. Branded as Springboard.
Correct.
Yeah. Which year that was?
Oh, so that would have now been, it was 2013 it ran, so it was 3 years ago.
Okay, and how was the IoT ecosystem at that time?
It was awful. In some respects, actually, that program was too early. And I think one of the things I felt was there was a lot of hype at that point in time around it, but there wasn't a lot of substance. And as a result, the vast proportion of those teams just didn't succeed.
Okay. So how many teams were at the program, if you recall that?
So there were 10. I think there were 9 teams, and of the 9 teams, I think 3 are still in existence today.
Okay. Okay. So six of them failed.
Yeah.
Do you still keep in touch or keep track of with the founders? And have you ever investigated what's the reasons of the failures?
Do I keep in contact on a periodic basis? I won't say I speak to them weekly, but I definitely do speak to them on occasions. I think this is kind of pretty public. I tend to feel that hardware businesses are extremely hard, and I know everybody knows that, but it's true. I think there are inherently lots of challenges around them, and one of the biggest problems, I think, is actually trying to get additional funding to grow the businesses as well. So investors tend to be very shy of the businesses. I think the high level things which are problematic are, one, you tend to have slightly larger teams than you would ordinarily do. I think, two, making things work in the real world is actually much harder than trying to do things virtually in code. I think the timelines, because they are physical, are much longer than you would ordinarily have. And three and four, actually, interestingly, you can actually work out what the unit economics of any given product is. And so sometimes the way I describe it is, if you have Instagram, you can always have, imagine if all of these users were all worth $10. Now, you don't have to prove it. Interestingly, when you have a piece of hardware, the challenge you have is you buy the hardware for $50 and you sell it for 100. So therefore, you're stuck with it's worth as a profit $50. And you might be able to put services around it, but it does inherently have a limited upside. And actually, just the sales and how you do sales is much more limited than you would, for example, by downloading an app from an app store. So I think there are a lot of friction points associated with IoT. Having said that, I also think that IoT has moved on a lot, but and the opportunity is bigger. But it's also a very, very broad space. It encompasses a lot of things. It's a bit like saying, imagine software in the real world, or imagine software in the non-real, in the virtual world. It's actually a very, very broad scope of the business.
Okay, cool, thanks. Do you recall what were the stages of the companies that joined the program?
Yeah, all of them were either pre-launch or pre-manufacturing. And I think one of the challenges you have clearly at that point in time is, how does one get product through a pipeline and manufactured within economic constraints that would require it to turn into a real product? Okay, and have you drawn some conclusions? Which of the stages are usually struggling with reaching that, the timeline and delivering in time, and which stages are kind of cranking towards it and can successfully go further? I think they have different challenges at different stages. I think the timelines for our IoT are much longer than a traditional software business. Part one. Part two, investors tend to be reluctant until you can demonstrate that you can build it in the manufacturing. And then when you get to the other side of manufacturing and starting to distribute, then you have to think much more carefully about product branding and services. So it actually becomes less about the piece of hardware, because essentially you're always open to the risk that a cheap Chinese manufacturer will be able to build your product for the same price. And so therefore service and branding actually becomes much more important to be able to create premium for potentially sale of the product. Okay. Well, you mentioned the Chinese manufacturers. What's your opinion for the European IoT companies on dealing with Chinese manufacturers? Is it worth it, or at the early stages, is it worth to try to find manufacturers here in Europe? Do you have any opinion on that? Not substantive. I think a lot of the companies that I have worked with and continue to work with actually just ultimately end up in China, because I think the broad base of the products that they generate is much broader, and it's much easier to identify potential partners. I think the biggest challenge you have, I think the way somebody quoted it to me once was, if you have a Chinese manufacturer, get a sleeping bag and be prepared to sit at the end of the line, and make sure you check everything that comes off the line, because as soon as you go to the toilet, the quality of the product completely disappears. And so therefore, particularly for your first batch, you have to be very active and very hands-on to ensure that the quality of the product coming off is to the standard that you would hope or expect.
Okay, makes sense. So John, your programs usually run for 3 months, right?
Correct.
And so you have or at least had a very clear distinction between the 3 months, what's happening in month 1 and what's happening month 2 and month 3.
Yeah.
Was it the same structure for your IoT program? And can you explain to the listeners of the parts in your program?
Yeah, look, coming back to my point, I ran a program 3 years ago. It had a very similar format to that of a traditional accelerator. I think in retrospect, it probably wasn't the right format. I think one takes longer to make these things valuable. And as a result, I think if I were to try this again, I would almost have a 3-month sprint followed by a further 3-month sprint. I think the other challenge is, depending upon where a given team is in the cycle, either pre or post production, they will have very different needs. And also, coming to my point, IoT is inherently a very broad subject matter, and so I think one's expectation, to some degree, IoT is like saying we're going to run an accelerator on Ruby on Rails. It's kind of a functional type. It doesn't necessarily describe anything apart from a very broad category. So I think it's important to try and focus on the needs of the business, but also be willing to think about whether they're software businesses or whether they're hardware businesses, and inside that, what sector they might come from.
Okay, thanks. So, as I remember, your IoT program, at the end of it, you launched a Kickstarter campaign where all your teams.
There was optionality. I think of all of the teams, nobody actually ended up taking up that opportunity.
Yeah. You know some of the reasons, were there just too little publicity, or?
I think of the 9 teams, only 2 or 3 of them were really B2C products, and also the amount of time and energy required to prepare for a Kickstarter campaign. Typically, you need between 2 and 3 months just to make sure that one's prepared for a Kickstarter. So combining that with an accelerator, I think, is inherently very hard to do.
Mm-hmm.
I think people shouldn't underestimate the amount of energy that's required to make a Kickstarter campaign work.
Okay, so for a young IoT startup, what would you rather suggest? Trying a luck on a Kickstarter, as nowadays we see many Kickstarter projects, hardware projects coming out of it and being funded, and so you kind of incentivize people to put up the product there. What would be your advice? Kickstarter or traditional ways, angel funding, approaching VCs or similar?
So I don't think there's one simple answer to your question. I think there's 2 or 3 things to think about. One is, if one is planning on doing a Kickstarter campaign, you almost need to ensure that the first third of the funding necessary has already been determined or agreed, or the demand has been addressed. So effectively, in the first 48 hours, you really need to ensure that you get to at least 30% of the overall target. I think based upon that, the basic statistics prove that more often than not, you will get to your end target. So if you determine the other way around, this is the thing about it, is the number that you achieve in the first 48 hours, if you multiply it by 3, that's what your final total is likely to get to. So I think there's a lot of pre-planning that needs to be done. I think Kickstarter is a really valuable way to demonstrate demand and to better test the product and the pricing around it. I've seen a lot of IoT startups which have historically raised money and then used things like Kickstarter and Indiegogo as effectively a sales channel initially rather than an investment channel. I have also seen on the other side startups that have used Kickstarter and Indiegogo as a way to stimulate interest and demand. The biggest problem you have, and I have seen teams struggle with this, is even if they are successful, I have seen products post Kickstarter actually pivot towards something totally different. And the greatest challenge around that is because you promised Kickstarter campaigners a given product, is really hard to flex away from that. So you kind of become bounded to those products themselves, even though that might be version 1 and you might want to be selling them version 2 very, very quickly afterwards. So you almost become limited to whatever promises have been made on Kickstarter. And so it's sometimes hard to progress the business faster than you might want to. Okay,
thanks. So, John, as far as I understand, you have a pretty good overview or understanding of the investment ecosystems around Europe.
Yeah.
And different countries investing in different markets. What would be your top 2 or 3 countries that you would go being an IoT company, or is it divided in other ways like healthcare and so specialized verticals?
I think the coming back to I don't think the European market is sufficiently large enough really for any given jurisdiction to have ownership of any given IoT segment or sector. I think the key dynamic is trying to identify the key investors in any given segment, in any given location. I think if one excludes angel investors for now, if one is looking at institutional investing, seed investors or Series A, I think most have a pan-European focus. I think one has to constantly remember that up until recently, and still remains so, London has the most capital to deploy, probably closely followed by Germany and France, I think, are the current statistics. I think Tech.eu recently published some information around that. I think the key to it is to really spend a little bit of time and energy focusing on things like Crunchbase, things like Dealroom.co, things like AngelList, to identify who individual investors who have interests in hardware to be, because most investors have a pretty black and white view about whether they invest in hardware businesses or not. I think it's very hard to persuade someone who has not historically invested in hardware to do so. But that's not to say that IoT is just hardware. I know that there is a huge interest around IoT businesses which are only software. I know Cisco has a venture fund specifically aimed at software businesses that are targeting IoT.
Okay, thanks. So you mentioned London has a lot of capital to invest in, and well, a lot of startups know that, and it was kind of a tradition for a more successful teams to move to London, at least from around Europe, to move to London and start a business, establish a company and do a business there, or at least have a headquarters. How do you think the Brexit? Obviously, it's not a question that you might hear a lot of times. How do you think the Brexit affects it, or it doesn't affect?
I think the answer is I don't know. I think if 4 weeks knew, I think I'd be a very rich man. I think it depends where you are and what you've achieved so far. So my suspicion is if you're a European business, I think where historically you may have moved to London, I think there's probably not the same rush to London as there may have been historically. I think locations such as Berlin, Paris, or Dublin feel like natural locations at this point in time. If, however, you already have some jurisdiction in the UK, I think equally where 2 weeks ago, I think there was a bit of a blind panic, which was, I think we need to move to Berlin or to Dublin. I think the immediate panic and rush has gone away. I think it will create some challenges around funding. I would not want to be anybody trying to raise funding at the minute. I think particularly over the summer months, it's hard, but I think between September and December, there's going to be a lot of uncertainty and question marks around what next. I hope it's not true, but I think just investment in general will be harder than one would hope.
Okay, thanks. So you gave quite a lot of already advices to the startups that are listening to this session. Kind of recapping this, most of the startups just joined the program, just joined the startup scale up.
Yeah.
And what would be your one piece of advice for these companies? How should they spend their 6 months?
Go and find some customers.
Easy as that.
Customer development is singularly the most important thing any startup can do. I think, and this is a completely made up statistic, $1 of investment capital, sorry, that's a lie. $1 of sales is worth about $5 of investment capital. And what I mean by that is if you have sales, if you have sold your product to someone else, A, demonstrates that you address a market need, B, you can sell a product, C, you have demonstrated a price point or a willingness to pay for the product, D, because you've sold it, you don't necessarily need to raise that from a third party through investment. And so therefore, the combined value of sales to third parties, even in its earliest stages, are inherently much, much more valuable than necessarily chasing investors. So I always say one should be spending 5 hours of your life with potential customers trying to sell product, on only 1 hour necessarily trying to raise investment money. I think if you've got sales, your capability and capacity to subsequently raise investment capital is substantially higher.
Okay, thank you very much, John.
Okay.
So let's move to the second part of this session, the questions and answers. So we received a couple of questions over here. One sounds like this. If you don't understand any part of it, just let me know and I'll try to read it again. There are many accelerators across Europe. Startups, we have got a short time window, so we need to hit the target when we're selecting the correct program or accelerator. Besides technical and functional filters that fit our company, what are the indicators you recommend us to choose on international accelerator?
So when teams approach me and are interested in joining an accelerator, one of the things I'm very strongly in favor of is reviewing the alumni, teams which have been through a program before, and reaching out to them directly and asking them what they think. Most founders are quite accessible post-program. I think they're the people who can add most greatest insight into how valuable a startup or a startup accelerator has been to their business. When I used to run Techstars, I used to regularly say to teams who were applying, make sure you speak to some of the founders of the business which participate, because they will have a better view upon inherently the underlying value of participating in the program or not.
Okay, thank you. Okay, the other question is this.
Oh, let me finish that off. If any accelerator doesn't want you to talk to any of its alumni, that to me is a red flag as well.
Okay, that's a very interesting thought. Good. The other question is regarding the internalization process. A possible strategy could be to participate in a specialized accelerator in each country. How you think about that?
I think it's considered to be acceptable to probably do 1 or 2 accelerators, but if you're continuing to do multiple accelerators, I think one has to question whether or not one really has a business. So typically, I think the tradition I've seen happening is people to participate in a general program, which doesn't necessarily specialize in any given subject matter, and then subsequently to participate in a vertical accelerator to which there may be some speciality around the topic area. I think participation in accelerators is incredibly valuable, but one of the biggest problems you have with it is it does consume a huge amount of time and energy around the company, and so therefore one has to think about whether one is spending all of your time and energy on an accelerator or actually building your own business.
So I think you, John, know more than all of us what does the term startup junkies means. Can you explain that to the listeners?
Startup what?
Accelerator junkies.
I think I've heard it otherwise known as serial accelerators, which is kind of essentially companies which go from one accelerator to the next and always just raise enough money from the cash to keep themselves alive, but they don't necessarily make any progress forward.
Yeah. How does the accelerators and evaluators view such startups?
I think independent accelerators are very dubious of it. I think corporate accelerators who tend to be slightly less fussy and are really interested in something which I call startup tourism tend to not be so suspicious. I think the disadvantage or the advantage of corporate accelerators is that sometimes you can do them for zero equity. And so therefore it feels like you're participating. But the other side of that is it is taking up a certain amount of your time and energy.
Okay, thanks. Okay, so last 2 questions.
Right.
Leon in Core Lab asks, what do you think of Dragon Innovation to carry out an assessment for hardware design in order to obtain a commercial product from functional prototype? Do you recommend any other organization for this kind of assessment?
The honest answer is I don't know.
Okay. Okay, and the last question.
I could lie, but I don't. I genuinely don't.
Okay. The last question is this. We are incorporating our company in the following weeks, and we are building the stakeholders map. From an investor point of view, what would be the logical percentage of an advisor, of a strategic partner, and of an important employee? How much should the founder keep for themselves?
The general expectation is that, well, if it's a single founder, it's slightly different from multiple founders. So one...
Could you cover the scenarios of a single founder and a multiple founders?
So if you have multiple founders, most good startups typically don't have more than 3, maybe 4 maximum founders. If you have more than that, it tends, you tend to find that you lose people along the edges, so to speak. I, as an investor, would expect to see that if you have 4 initial founders or 3 initial founders, that the equity would be split equally between those 3 or 4 people. When shares are not distributed equally, it raises a question. It's not to say it's wrong, but it does raise the question. I think the other key dynamic at that early stage is that vesting contracts must be put in place for the original founders. What do I mean by that is you earn those shares over a period. Vesting contracts are something for the protection of the founders, not necessarily for the investors. I think that's sometimes misunderstood. The key terms and conditions you'd expect to see is you earn your shares over a 4-year period. You typically earn them either on a quarterly or a monthly basis, but also you would have something called a 1-year cliff, which basically says if you subsequently leave the business within the first 12 months, you don't earn any shares at all, because that's the period during which you lose most of those early founders. If you have multiple founders, there is essentially a greater coverage of all of the skills that you typically need within a founding team. If you're a single founder, what you typically find is because you're a single person, you need more experience from other people around you. This isn't set in stone, but my expectation is for the period from inception or incorporation through to the first round, you should be looking at an option pool of up to 10%. If, however, you're a single founder, one would need to be thinking hard about having a larger pool, maybe up to 20%, because you will need other senior members of management to help support you because you don't have co-founders. As for the shape and size of the shares that you would expect to be giving away, let me share with you, this doesn't talk about necessarily early stage employees. I think one has to make a decision about those, but if you check out the following link, I will put in the bar. This gives you a good idea of what you should be giving advisors and founders. I think the key to look at is essentially what stage your business is at and how much input you would hope or expect to have. But the key I would expect is advisory shares. You shouldn't really be giving away at maximum more than 1%, particularly at an early stage, but traditionally it will be between 0.5% and 1%. Early employees might be single points, 1 or 2. If it was a really important hire, like a CTO that you felt that you need to include, you need to figure out whether you really consider them to be a founder of the business or whether you really think of them as an early employee. And you could potentially be giving away as much as I've seen between 5 and 10% for really, really critical employees. What I mean by those are people who you would look at and say, if they were included as part of the founding team, my ability to raise additional capital would be significant.
Okay. That's a great answer. So we received one more question.
Yeah.
From Leonardo Teles. We are developing a cloud. Okay, I lost it. 1 second. Where is it? We are developing a cloud service product. What's better to build the product fully by ourselves and have the control, or to hire developers to make it faster and avoid losing customers' interest?
I think the bigger challenge, it depends on whether you've done an investment route or not. So as an external investor, I tend to be very nervous about products which are built outside of the key investing team I'm writing a check for. If I'm investing in a business which is all about technical capability and skills, I would become nervous if you said, and we outsource that. The alternative is a halfway house, which is essentially to have key technical individuals inside the company itself who can help manage the build of a product externally, which allows you to maintain and control from a technical perspective what's going on, but accelerate your growth. But the long-term vision and view of the organization, I mean by that over 12 to 18 months, is that you would aim to try to bring the technical team inside the organization rather than having it deployed outside. I think sometimes people also don't really understand the cost implications beyond dollars of externalizing their development. One, because external developers will be working from 9 o'clock to 5 o'clock, whereas internal developers will be working much longer hours. External developers will be much more subject to what I would describe as setting specific specs and requirements. And it's very difficult to adjust those specifications or requirements midway through a project if it's external, because it will lead to cost overruns, whereas without an internal team, you tend to be much more flexible.
Okay, thank you. John, are you aware of the conferences and events where IoT startups could go and showcase their product? Are you aware of any that are effective, that you found interesting, whether they are in Europe, in the States, or elsewhere in the world?
I think the obvious one to look at is, whilst it's expensive, is TechCrunch Hardware Alley. Is a place where a lot of investors who are specifically interested in hardware hang out. I think for everything else, I think one has to be, to some degree, less discriminatory. I think the number of investors who do hardware are much fewer. And so therefore one probably needs to just try to not just attend more events than you would ordinarily do, part one, but also raise your profile so that it's much easier for external investors to identify you if they are interested in investing in such things.
Okay, great. Okay, and so the one last question, John, do you do investments individually as an angel investor from time to time?
I historically did, but because I'm now about to join a new investment firm, I will be very, very limited in my ability to do that.
Yeah. So it's a theoretical question rather than the practical. Would you yourself ever put money on a IoT company in these days? And what would be the conditions you would make an investment? I have invested in hardware businesses through an accelerator. Have I personally written a check outside of an accelerator? No. All of my last 3 investments personally were around blockchain technology. Okay. Great.
You tend to find that people are very specific about what they like to invest in and what they don't. Yeah,
yeah. Everyone has their sweet spot.
Yeah, okay. And it changes all the time.
Okay, thank you very much, John, for sharing this with us.
Not a pleasure.
Good luck with your VC fund, and hope to see you soon, whether at some sort of event or somewhere else.
Excellent. Thank you for that.
Okay, cheers. Bye.
Cheers.